we'll move on. In a bit of a change of pace and style now, I want to spend the next few minutes in conversation with Mike Lee. I'm sure you've heard Mike's name. Mike joined FPC earlier this year as investment director. I'm not going to steal his thunder because I'm going to ask him a little bit about his background, but in shorthand, he has a long track record in wealth management in the UK, private client wealth management in particular. What I'm particularly interested in hearing from Mike about is how FPC can help its clients navigate the choppy waters that we've heard about from Martin and Peter. So I was going to say, please come and join.
I've already joined you.
But you're here. Okay, come on. Welcome on board.
Thank you.
Right, let's make ourselves comfortable if we can.
Am I on?
Yeah, you're on.
Okay.
You're on. You're on. You've even got some slides. Oh, my goodness me. This is...
Thank you.
There's no end to the technology. Right, okay. Right, picking up from my introductory remarks there, Mike, why don't you tell us a little bit about your background and then tell us what it is that you think you bring to the party. How are you going to add value to FPC?
Okay. So good afternoon, everybody. I've been able to meet a few of you before the event today. I've managed to meet a few of you also this morning. So hopefully I'll get to see a lot of you later on and get to speak to you. I think my part in this segment is to try and lighten the mood somewhat. And nothing says lighten the mood like a big comic dog on a bright yellow background. So just to explain a little bit about my background, I have been in investment management, working for a discretionary fund manager for about 15 years. I was a stock trader, and I was a private client portfolio manager as well. And my experiences within the industry, I've worked through the financial crisis. I've worked through the Greek crisis, if you recall that one. It seems modest in the big scheme of things. And I've worked through the period after the EU referendum, which was a shock to markets, maybe not a shock to some, but certainly to markets. But I got to the point where I was a bit fed up with the idea of short-term performance investing, trying to beat an index, trying to beat an arbitrary benchmark, or even trying to beat a competitor in terms of performance. It seemed to take away from what we were trying to achieve over the longer term for a client. So whenever I was speaking to a client, I always found that clients were never necessarily satisfied with performance because the target was always moving. So whether you delivered 3 and the market delivered 4, or you delivered 5 and the market delivered 3, it would change year on year on year on year. And there was no context of a wider financial plan. Hence the picture of a dog chasing its own tail. Or the target is always moving, and it's never and they were never satisfied. So I wanted a bit of a change, and that's when I found myself at FPC. So my experience and the value I bring is a deep market understanding, knowing how asset classes move according to different market conditions, and also creating an additional rigor to the investment opportunities that become available to our clients. Now, I always said that when I get to my deathbed and I'm lying there, the one thing I'm not going to say is, thank goodness that I beat the FTSE 100 by 0.5% every year. That's exactly what I'm not going to say. So the satisfaction level I got from that I'm going to get by working with people who have a broader financial plan rather than just focusing on what happened in the next 12 months is why I moved over to FPC. A very, very small background for me. When I'm not working, a lot of my time is spent working with young athletes and athletic development. I run a club. We have about 200 kids who play between the ages of 6 to 18. Now, you try and learn some lessons that you can apply to your business life as well, with your personal one. Now, the lessons I take from it, for those who have children who've played sport, there's this mantra of winning by Saturday, which is doing whatever it takes to get a result by this weekend to appease players, to appease parents, whatever it might be. But it's quite often at odds with what you're trying to do with the longer term to develop the child that you might be working with. So there's lessons that can be taken across in terms of ignoring the noise that we see daily basis and focusing on the longer term and what we're trying to achieve. So, very happy to be at FPC and looking forward to meeting everybody and working with you as we go forward.
Great. And specifically as investment director, the role you've come in, I'm sure you've spent many happy hours getting up to speed with FPC, testing, challenging. I know you have what's been going on before you arrived. What's your view of the FPC investment process that you're now responsible for? And how does that align with your own thinking?
It's certainly been a steep learning curve. Learning the processes of the company, the history, the client information. One of the hardest parts, I would say, is trying to extract all the information out of Mark's head. There's 30 years of deep information there and knowledge, and we've spent many times challenging each other, but thankfully we share the same principles. When I was listening to Martin speak particularly, I was getting all confused because I didn't actually know where the message was coming from. I thought the message was coming from Mark, but I think that the message might have come from Martin via Mark over to me as well, because we're all saying the same things. But one of the core principles that we concentrate on is the idea that prediction is not possible. There's very, very smart and intelligent and experienced people amongst us, but none of us can reliably and consistently predict what's going to happen in the future. Now, there was a study done in 2017, and I think Martin might have been referring to it, and Mark certainly has. And the study was called Guru Grades. And the academics involved in this particular study, they took 68 well-respected market forecasters, and they took 6,000 individual market forecasts, and the evidence that came out was that there was an accuracy rate of 48%. So they were as likely to be right as they were to be wrong. So basically totally random. Now, as Martin said, in terms of forecasts, it's simply an extrapolation of what the most recent history is, what the most recent information we have. It is career risk for some people, if you're trying to forecast the future, to do anything other than a minor adjustment to what information you currently have available. Otherwise, you'll be considered to be a radical, and you could end up losing your job because your ideas are too far-fetched. Now, Nobel Prize-winning psychologist Daniel Kahneman, he's often cited, very heavily involved in behavioral economics. He said that hindsight blinds us to the uncertainty in which we all live, in that we exaggerate the certainty there is, because after the event, everything is known, everything is obvious. Now, what we do as investors is we try to create a framework of what has happened in order to give us a feeling of being in control with what will happen going forward. But we know that the forecasting is not accurate. So I am an advocate for living with uncertainty and accepting it, planning it, and trying to worry about the things we can't control in the future. So in terms of our investment process and what we do, and I am repeating what has been said several times already, if you don't know what the future is going to be, you must plan for a number of outcomes. It's as simple as that. So diversification is the only true wealth creation strategy, particularly when it's not your money. Otherwise, you're going to be considered a gambler if you're taking one particular bit. And that's not the responsible way to act as a fiduciary of your money. So FPC, we don't try to predict things, we try to plan around the probabilities rather than the possibilities that might exist.
And is that how you then, you shorthand for FPC, is that how FPC manages investment risk? Or make it come alive for us. How do you actually then take what you've said and turn that into a process for managing investment risk?
So in terms of the idea of investment risk first, before we talk about how we put it into our process, investment risk is simply the range of possible outcomes that might exist with our money. So we need to not avoid risk, we need to manage risk. But I was giggling to myself before, Martin, because you started doing your flying thing. And I thought, is he going to say the same thing that I'm going to say? And in fact, he didn't, which is good. And I won't stand up and do the movements. But the concept of risk is by whether or not you've experienced risk. So if you are a flyer, if you are a first-time flyer, and I'm borrowing this actually from an old colleague of mine, and you hit a period of turbulence in your flight, then you are going to have all kinds of emotions going on, and you're going to consider the worst-case scenario. Whereas if you are a seasoned flyer, then it's not going to impact you as much, and you're going to sit there basically undisturbed because you know you're still going to get to your destination. So that's how I think about risk. But the idea is that time is the most crucial part with risk. If we have, how long we have to meet our goal is how much risk potentially we should be taking with our portfolios. If you don't need the money, then it is almost irrelevant what happens within the interim between investing, providing you meet your end goal. So that's what we're trying to say. Now, this might be a bit far-fetched, but you'll be, because of the age gap, but you'll be forgiven thinking that this is Mark Ralphs back home, sat in his study on a Sunday afternoon with his paper, right? But this is actually Warren Buffett, who you'll be able to recognize, many people. Now, Warren Buffett is one of the world's greatest investors. He's amassed a fortune of $80 billion. And now he's done this from buying and holding over the long term, quality companies, and letting his performance every year compound year after year, decade after decade. And that's how he's amassed his wealth. What he hasn't done is gone and bought and sold on market highs and lows. He's rode all the way through the journey, and he's created wealth at the end of it. Now, he has a saying, which is often cited, and it's that the stock market is a mechanism for transferring money from the impatient over to the patient. So our concept of how we look at risk is that it's a case of being how much time you spend in the market rather than timing the market with the ups and downs and trying to buy and sell, which is a common error that we try to avoid. Now, our investment process, therefore, we have to make sure that when we're investing your money into the funds that we want to invest in, according to our strategic asset allocation, our SAA, we need to make sure that we are buying the right kind of funds. Now, we've always had good due diligence in terms of which fund we include in portfolios. But it's quite topical at the moment that we're actually enhancing how we look after clients' money through a partnership that we've just adopted with a company called Square Mile. Now, Square Mile are an independent research house who actually go and sit down with the fund manager that we put your money into that fund, and they eyeball them. And they say, are you delivering what you say you're going to deliver? If they're not, then they need to be able to explain it. And when they explain it, they need to put it back to us, and we, as an investment committee, need to determine whether or not that's acceptable. If they deliver 10% growth, or they lose 10% value, but they said they were going to deliver 4%, then we need to know why that is. So Square Mile are going to be it's going to be a name that you'll hear when going forward as an added part to our investment process, making sure that we are avoiding the funds that you typically hear about in the press. They also give us an angle of our ESG, our environmental and social and governance being a key one, further to a question that came from the back of the room. ESG and making sure that the funds we are going in are trying to have an impact on the sort of areas that Martin was talking about earlier. So they're going to be a big help to us moving forward to make sure we're in the right places with your money. Now, in terms of Neil Woodford that was mentioned, this to me, without going into the details of it, because it has been covered to some extent, this is an area of governance, the G part of the ESG. You know, he set up a particular fund. He was working at Invesco. He followed a process, and he made a lot of people a lot of money, including himself. He then left in 2014, set up his own firm, and it seemed from the outside at least that he was investing in a manner that he wanted to invest in, come hell or high water. It was, and so the question is, was he being challenged within his organization for the size of the positions that he was taking within private companies or not? You know, did he have such a profile that people felt like they weren't able to challenge him within that organization? So the governance side and being able to identify the fund managers that they're doing what they say they're going to do and being challenged for it is how we bring it into the process.
Critical. You've used the heading, Mike, I think at the beginning of this presentation. It was also on the previous slide, winning by not losing. That's a phrase I'm quite familiar with. But for those people who may not be familiar with that phrase, what do you mean by that?
So does anybody play tennis? Raise a hand. Anyone play tennis at all? Yep, a few tennis players. Okay, good. So if you don't play tennis, but you know how tennis works, essentially the concept of winning by not losing was introduced by US investor Charles Ellis in a book that was called Winning the Loser's Game. Now, when you play tennis, you can either win the game against your opponent by hitting more shots past them, or you can win the game by making fewer errors than your opponent and letting them try and hit the winners. So now I understand that when you're playing tennis, everybody likes to win, right? We like to hit that shot. You know, to think that we can hit that baseline corner shot whenever we want because we're that skilled, when really inside we know it's a fluke, but we try and make that shot anyway, and everyone goes, that was a cracking shot, well done. You know, have you been playing tennis for long? And all that kind of thing, and you're getting a pat on the back. You know, we all like that feeling, just the same as when, you know, you back the right horse at the Grand National, and you come away going, oh, I know what I'm doing, you know, it was a good horse, you know, but actually it's a complete fluke. We know it's a complete fluke, unless you're very highly skilled, okay, and there's few of us that are super highly skilled. So when we try and apply this to investing, it is about understanding what we can control and what we can't control. Now, Harry, Martin, Peter, the rest of the team cannot control the stock market. You know, so if you think that we can do, then you're probably in the wrong room. We can't control the stock market, so we just need to say it. What we can control are our behaviors. We can control, are we overtrading? We can control, are we using all our available tax allowances? Are we concentrating on the cost of the products that we put into your portfolio, which ultimately detract from the return that you get, which is ever more important nowadays. And another important part of it is about investor behavior as well. Are we ensuring that investor behavior is appropriate to what we're trying to achieve over the long term?
What do you mean by that? What do you mean by investor behavior, and why is it so important?
So this is an area, it's an area that I'm really interested in, which is behavioral economics and the psychology of investing and why we do what we do. Because we all like to think that we all like to feel like we're rational, okay? But there's, and I'm not calling anybody daft here, but there are hundreds of biases that make us think and act in ways that would not be considered all that rational. And this is what I'm trying to get to with regards to behavior. Now, that could have been me a number of years ago when I was less grey. Maybe that caused me to be more grey. But what we're trying to say here is that all the information that we are inundated with on a daily basis in our personal lives, in our business lives, our financial lives, you know, waking up in the morning, rolling over. Some people will do it, some people won't. Looking at your phone within 20 minutes, all you've got is information, social media coming through, problems from work, questions from home. You're getting bombarded. We don't have the time to be able to make detailed decisions that are consecutively in our best interests. We just don't have the time to do that. This table's wobbly.
Yeah.
Because thinking's hard, right? And you have to exert energy to think. So, it's going to annoy me this now, this table. It's hard. That's why a recommendation from a trusted source works so well. When you're looking for somebody around the house, somebody to work around the house, or an advisor, or whatever it might be, a professional, you have to think about all the options available. But if somebody says to you, why don't you try Dave? Yeah, why don't you try Jan? You go, okay, I'll do that. That sounds like a good idea. Now, have you really considered all the options that are available, or have you taken a shortcut to come to the easiest decision? And that's kind of what I'm trying to highlight. Now, what about when we are in a period of stress, or we're in a period where we're sad, or we are euphoric or fearful? We should all be able to recognize those feelings and know that that impacts our decision-making at the time. I know it at home. I know that I make certain decisions that are different when I'm not in a great mood or when I'm in a sad mood. I understand that. So we need to apply that to investing. So the idea here is that actually simple can be harder than complex, because we have to make our thinking clean, understand how we think before we make investment decisions. Now, I thought it'd be quite interesting just to show you a bit of an experiment. Now, has anybody seen this image before? If not, great. Okay. Now, this was an experiment undertaken by Solomon Asch, who was a psychologist in the 1950s. Now, very, very simple, right? All you have to do is choose which line on the right-hand side measures that on the left-hand side. Okay, so we've all got it. We all know what it is. It's a simple exercise, right? Now, the screens are too big for me to try and suggest it's otherwise, okay, and try and pull a fast one on you. So I'm not going to do that. If the screens were smaller, or if there was more than one of me saying it's a particular answer, then it might work. So we'll move on. Now, the point of the experiment was that there was a room of 5 people. Within that room of 5 people, they had to vocally say which line they thought measured the one on the left-hand side. 4 of them were in on it. 1 of them was the subject. Okay? Now, what the experimenters found was that in a third of cases, if the 4 people who knew what the experiment was said that it was the wrong answer, then the 5th person in a third of cases would agree with them. Okay? So it's a form of conformity bias. And the 2 reasons given for this behavior was, if I'm the only one that thinks it's this and everyone else thinks it's that, maybe I'm wrong. And the other answer given was, I know that I'm right and I know that they're wrong, but how are they going to behave if I give a different answer? So it's these kind of thoughts that go through our head that make us behave in a particular way. Now, what if it was a more ambiguous decision? What if it was a case of investing in A over B, and you had no experience, and the subject was particularly complex? Then I imagine the conformity rate and the suggestion from somebody else to do a particular thing would be all that much higher. So we have to be aware of that. But because we've got all these biases, what it means is that we need to have a solid investment process backed by sound principles that we can follow all the way through.
Thanks. Right. Now I'm going to bring this back down to FPC now. Thank you. After that. And some of the comments you made in your initial remarks about the reasons why you joined FPC and why you're finding it such a fulfilling experience. I'm not sure you said that, but
I do indeed.
Yeah. So how are you personally going to help? How do you think you're going to help FPC's clients, a lot of whom are in this room? How are you going to help them continue to prosper?
The starting point is I think we need to set expectations correctly and understand that over the years, over the last decade, we have seen pretty exceptional returns from a number of asset classes. So we need to make sure that whilst Martin and Peter referred to the fact that, particularly Peter, that risk-free rates have never, ever been as low as they are now, then we need to set expectations that most other asset classes are priced off the risk-free rate. So it might be the case going forward that returns aren't as we have experienced in recent years. But if we can set expectations right, then that's a good starting point. The next thing is to make sure that you are in the right funds, using the right kind of research, and all our funds that we include in portfolios are there for the right reasons. Now, the US market makes up 55% of the total investable world, as opposed to the UK, which is just 5%. So FPC has a global bias. It will continue to have a global bias in terms of how it invests money, because that's where the majority of companies and value is being created at present. But it could be argued that the US is starting to hit a little bit of a ceiling, and that emerging markets is an area that we should now be thinking of and including within portfolios, given the structural themes that are taking place. It's interesting on the US performance as well. The US market is called the S&P 500. It's the 500 largest companies in the US. Now, 1% of the number of companies, just five companies in the US make up 15% of the entire value of the US market. So we're talking about Amazon, Apple, Google, memory stay with me, Facebook, and one other, I'm going to refer back to my notes, and it is Microsoft. Those 5 companies make up 15% of the entire US market. Now, if we can establish that if you had not been invested, even to a small degree within those 5 companies, then you would not have experienced the returns that have been achieved by investing in the US over the past few years. So it's important that we diversify, which we've probably about 6 or 7 times we've said that now, diversify to capture even just a small part of the small amount of companies that generate the majority of returns. So that's something that we need to be aware of, that we have a broad enough base to capture that performance. And finally, it would be about communication and making sure that, particularly from me, because I'm being charged with this now, over to you, that you are aware of our thoughts when it comes to investments, the kind of decisions we're making for you and how it will impact you. Now, it's not just the investment world that changes rapidly, because it does, and you can ignore most of it, granted, but it's also the tax side and it's the law side as well. So what we need to do is we need to make sure that we have the right partners working with us to support you in terms of the areas that are not our competence that we need to bring in as part of your bigger picture, the financial plan. So if we can take away the worry, hence the slide, and we can take away the stress from you and take care of things, then we can free up your mind to think about the things that are really important to you, rather than worrying about what's going on in the stock market tomorrow.
Okay. Mike, I'm going to bring this session to a close, but before I do, can I just ask you one final question? And it's this. If you were to leave one thought with this audience, or give them one issue or one question that they should perhaps go away and think about or ponder about, what would that be?
So very simply, final slide, final question is having a margin of safety. Reframes how we look at risk. It changes the comfort level that we have with dealing with risk if we have a margin of safety. A margin of safety was a concept by Benjamin Graham, who's a classic US investor, who basically said the point of having a margin of safety, and we're referring to cash here, the point of having a margin of safety is making accurate prediction of the future irrelevant. We don't need to sit here and predict, and you don't need to hear our predictions about what we're going to do with money, because the plan should allow for a change in that prediction, which we know is not going to be accurate in any case. So having a margin of safety separating cash from investments gives us a feeling of being in control and comfort, and going back to one of our phrases, being able to invest with confidence going forward.
Fantastic. Thank you, Mike. Well, thank you very much for joining me on stage. We're not actually going to do a Q&A session, but Mike has kindly reiterated that he's available for conversation with any of you at any time. So if you have any questions, don't be shy. Please come forward and grab Mike. But will you for now join me in thanking Mike?